Welcome to our comprehensive tutorial on Asset and Liability Management, or ALM. In this video, we'll explore the fundamentals of ALM, understand its importance, and dive into examples and practical applications. Asset and liability management is a strategic approach to managing the balance sheet of financial institutions or corporations to ensure solvency and maximize profitability. It involves managing both assets and liabilities in a synchronized manner to mitigate risks, especially interest rate and liquidity risks. To grasp the concept better, let's look at a simple equation usually used in ALM. Consider a bank that has assets in the form of loans given to customers and liabilities in the form of deposits it holds. If the interest rates paid on deposits are higher than the rates earned on loans, the bank could incur losses. Therefore, effective ALM ensures that such mismatches are minimized. Now let's answer a common question. Why is ALM critical for financial institutions? ALM plays a vital role in managing various types of risks, such as 1. Interest rate risk. The risk that changes in interest rates will affect the institution's earnings and market value. 2. Liquidity risk. The risk that the institution will not have adequate cash flow to meet its obligations. 3. Credit risk. The risk of a counterparty failing to meet its obligations. 4. Currency risk. The risk arising from fluctuations in exchange rates. To mitigate these risks, financial institutions use several ALM techniques. Let's discuss a few. 1. Gap analysis. This involves measuring the gap between rate-sensitive assets and liabilities to identify potential risks. 2. Duration analysis. Measures the sensitivity of assets and liabilities to interest rate changes. 3. Scenario analysis. Evaluates the impact of different market conditions on the balance sheet. For example, let's visualize the concept using a graph showing a bank's assets and liabilities over different interest rate scenarios. This line graph shows how the assets and liabilities change over different time frames and interest rate scenarios. As you can see, the gaps indicate why careful analysis is needed to ensure the institution remains viable. But what about non-financial institutions? ALM is equally essential for them too. Manufacturing firms, for instance, need ALM to manage their cash flow and investment in fixed assets effectively. Let's look at an example. Suppose a manufacturing company is planning to invest in new machinery worth $5 million. This is a long-term asset. They would match this with similar term financing, perhaps a loan with a comparable maturity period, to ensure they can meet the loan payments without strain. In such scenarios, firms often use projection models to foresee how these investments and liabilities will affect their balance sheet over time under different economic conditions. Let's dive into a few questions to test your understanding so far. Question 1. What is the primary goal of asset and liability management? A. Maximizing liquidity. B. Minimizing the interest rate risk. C. Ensuring the synchronization of assets and liabilities. D. All of the above. Answer: D. All of the above. The primary goal of ALM is to ensure the synchronization of assets and liabilities to maintain profitability while minimizing various risks, including interest rate and liquidity risks. Question 2. Which ALM technique measures the sensitivity of assets and liabilities to interest rate changes? A. Gap analysis. B. Duration analysis. C. Scenario analysis. D. None of the above. Answer: B. Duration analysis. This technique measures how the value of assets and liabilities responds to changes in interest rates. These questions help reinforce the importance and techniques of ALM in managing risks. Now, let's explore some real-world data. Consider the following data showing the interest rates and corresponding asset and liability values for a hypothetical bank over 10 years. This analysis helps the bank to spot trends and make informed decisions. If there's a rising trend in liabilities without a corresponding rise in assets, that's a sign of potential trouble, indicating the need for strategic adjustments. Lastly, it's crucial to integrate technology into ALM practices. Advanced algorithms and software can forecast market conditions, automate gap and duration analysis, and simulate various scenarios to provide better insights and more accurate predictions. For example, many institutions now use algorithms and artificial intelligence to manage their ALM processes. These technologies provide real-time data analysis, ensuring quicker and more data-backed decision-making. By utilizing advanced technologies, institutions can efficiently monitor their risk profiles and make necessary adjustments to their asset and liability strategies in real time, increasing overall financial stability and profitability. In conclusion, asset and liability management is a critical aspect of financial strategy for both financial and non-financial institutions. It helps in aligning assets and liabilities to mitigate risks, maximize profitability, and ensure long-term stability. Effective ALM strategies incorporate various techniques, real-world data analysis, and technology to provide institutions with a robust framework for financial management. Thank you for watching this tutorial on asset and liability management. We hope you found it informative. Don't forget to like, share, and subscribe for more finance tutorials. If you have any questions, leave them in the comments below.